What's going on, you guys? It's Shiraz Ahmed coming at you with some more financial and business content. In today's video, I'm going to be going over my top stock pick for January of 2021. So stay tuned. All right, for those of you who aren't familiar with me and my work, my name is Shiraz Ahmed. I'm a financial advisor and associate portfolio manager with Sartorial Wealth of Raymond James, located in Toronto, Canada. I'm a cross-border licensed advisor, which means I work with families across both Canada and the United States and abroad, frankly, and helping them manage their wealth. So in today's video, I'm going to be going over my top pick for a stock that you could buy and put into your portfolio for January of 2021. Before I get too deep into it, if you could please smash that like and subscribe button, as it really does help the algorithm pick up content creators like me. And of course, if you hit the bell icon, you'll be notified the next time I upload a piece of content, which is actually every single week. So without further ado, let's jump in. Okay, so I'm going to preface and set the stage here a little bit. There's a lot of different ways in which people can invest. I'm sure you guys have seen on TV people talking about dividend-based investing and a lot of different strategies that are out there. Neither of them are better than the other. They're all just a little bit different. So for my clients in my practice, we actually implement a strategy known as momentum-based investing, which is also known as a factor-based investment strategy. Now, there are actually four major types of factor-based investing. One of them you're actually probably really familiar with, which is the first one I'm going to talk about, which is value-based investing. So value is a type of factor which is actually looking for investments that are considered to be undervalued by comparison to their peers. And this is actually also known as the Warren Buffett strategy, because that's basically what he's been doing for the better part of the last century. So it's tried, tested, phenomenal model. So the next strategy that I'm going to talk about is known as growth investing. Now, growth investing, it's exactly what it sounds like. You're actually looking for companies that are actually poised to do quite well within their respective industry and grow at a rate higher than their peers. The next one is referred to as size investing, which is a methodology where you're actually looking for small and mid-cap companies or smaller capitalization companies, because the theory is that they tend to outperform the larger capitalization or the big super tanker type companies that exist out there. Again, another tried and tested method. And the last one, which is the one that we actually implement in my practice, known as momentum-based investing, which in its basic forms is looking for trends and buying securities that have strong positive momentum when you're looking back over a 3 and 12-month period, and selling the securities that have a weak momentum over a 3 and 12-month period. For example, we would be buying a company like Zillow Group, which had a 12-month return of about 183%, and selling a company like Biogen, which had a negative 15% rate of return over that same 12-month period. So for my equity strategy, we actually need to rebalance our portfolio every single month to maintain a specific amount of risk at all times. So for the month of January, when we ran the numbers, our stock that had the highest conviction or had the highest scoring out of all of our universe happened to be Johnson & Johnson. All right, for those of you who aren't already familiar with Johnson & Johnson, if you've been frankly living under a rock for a period of time, but the reality is that they are one of the world's largest companies. They've actually been around since 1886, and they're considered to be a healthcare company, which also does consumer packaged goods as well. They are the owners of brands that you and I probably consume every single day. Some of the brands you'd be known, that you'd be familiar with, for example, are Band-Aid, Polysporin, Tylenol, Aveeno, Neutrogena, Clean and Clear, etc. So very well-known staple consumer brands that we would all be very familiar with. However, what people don't know as much about them is the fact that they're actually a very large pharmaceutical company, and that actually is over 50% of their overall revenue. So let's get into some of the qualitative and quantitative factors that are the reasons why Johnson & Johnson scored so well this month. Let's start off with the qualitative factors, or the non-financial factors. So Johnson & Johnson, like I mentioned earlier, is one of the world's largest companies. It's actually been a Dow Jones Industrial Average member since 1997. And they've actually been one of the best companies that you could have owned from a dividend investing standpoint for pretty much the better part of the last century. So they've been a phenomenal investment for a very long time. However, there are a few key points that I want to get into a little bit further. Another really interesting point about Johnson & Johnson is the fact that most people aren't familiar with the fact that they are a large pharmaceutical company. In fact, over 50% of their revenue is coming from pharmaceuticals. But that being said, Specifically, they're actually working on a COVID-19 vaccine, which is actually part of the biggest news and why that would be considered to be a qualitative factor of why you may want to look at owning Johnson & Johnson right now. In a recent Barron's article, this is actually considered to be a game changer. Main reason being is Johnson & Johnson is targeting a single dose methodology or formula for their vaccine. Unlike the Moderna and Pfizer, which actually are multiple doses, this one could be a potential game changer for the logistics and the ability to scale up the amount of vaccine doses that can be created. In addition to that, they're also not going to necessarily require the same sub-zero storage requirements that the Pfizer and Moderna vaccines require, which is like -70 or something ridiculous like that. Part of the challenge that we're having in actually rolling out the vaccine around the world is the fact that it is requiring these really difficult storage requirements. So that way, at the moment, for example, in Ontario, only the hospitals actually have the capabilities of being able to distribute the vaccine, as opposed to, let's say, going to your local doctor to be able to do the same thing. So that's kind of the major qualitative reasons or non-financial reasons that you might want to look at Johnson & Johnson as an addition to the portfolio for this month. Let's look into the quantitative factors, or some of the screens that we looked. And in my model methodology, we rely a lot heavier, or put a heavier weighting, frankly, on quantitative factors as part of our decision making on whether we want to buy a security or not in any given month. So let's jump in. There are lots of quantitative factors that people can judge a security on. Some people look at earnings per share, or other people look at dividend yield, and there's lots of that kind of information out there already for you. Frankly, in a 5-second either YouTube search or Google search, you'll be able to get all the information that you would want in that side of things. So I don't want to give you the same thing that you already have. I want to give you something a little bit different, which is how we look at it in my practice. So for the purposes of my practice and for our client base, we actually look at two main variables. Number one is return, and number two is risk. Specifically, when I say risk, in the industry there's a lot of different kinds of risks. So I'm going to dig in on one specific variable known as standard deviation, or the ability for a stock to do this on you, jump up and down, or how bumpy that ride can be. Unfortunately, most investors out there actually look at price returns on investments. The only challenge that can be is when you're actually creating a portfolio, it's really hard to judge two unlike objects. So for example, how would I judge the return of Walmart relative to, let's say, Franco-Nevada, which is like a gold royalty company? They're like apples and oranges. So it's very difficult to actually judge the performance of one security that is unlike to another security that is also unlike. We actually use a Sharpe ratio to be able to determine a company's risk-adjusted return, or return for every unit of risk that you're taking for it. And that's a way to be able to level the playing field a little bit and be able to judge an apple to an apple, frankly. The one thing you want to remember about a Sharpe ratio is that the higher the number, the higher or the better its risk-adjusted return is. So the higher the Sharpe ratio, the better it is overall. So what I do in my practice is that we actually take that information for every security that we actually screen for inside of the universe and look at how did it do 1 month, 3 months, 6 months, 9 months, and 12 months ago. And basically, we call these things look-back periods. So ultimately, how did it behave over this period of time? And the reason why we do that is that this actually helps us determine what is the momentum looking like for the specific security. Okay, so now let's do the same for Johnson & Johnson. We looked at the 1 month, 3 month, 6 months, 9 months, and 1 year return and risk, also known as Sharpe ratio for Johnson & Johnson. And as you can tell, at the beginning part of the year, it actually had a decent upward trend, and then it basically fell off a cliff towards the end of Q1, like every stock did in frankly, for the most part of the world, given the whole COVID crisis that we had. So it was actually exhibiting some fairly negative momentum at that point in time. And it kind of was in this kind of sideways pattern for pretty much the bulk of Q2 and Q3. And then towards the end of Q4, we started to see Johnson & Johnson exhibit positive upward momentum, which actually so far extended into the beginning of January so far. So the model effectively interpreted this as strong relative performance for the amount of risk being associated with this stock, and it's picked it up as a fairly strong buy recommendation. And now we take this process and actually rinse and repeat for over 40 securities. And so it just so happens that for this specific month, Johnson & Johnson scored the highest. Its current weighting in our portfolio is actually a little over 17%. So it is a high conviction security on our side. So hopefully this gives you some different reasons as to why to actually look at Johnson & Johnson from a kind of more quantitative standpoint. But overall, it's been a phenomenal investment owned for a very long time for different reasons. For our side of things, to kind of reiterate, we actually implement a momentum-based investment strategy, which is frankly different than a lot of my counterparts. We also dig a little bit deeper into the qualitative and quantitative factors, the fact that Johnson & Johnson is actually working on the vaccine, but they're also a consumer goods brand that you and I all know we consume every single day. And lastly, of course, our screening methodology basically ranked it extremely high because of its strong price momentum in the last quarter here, and also the fact that it actually has a very high risk-reward ratio known as a Sharpe ratio. So hopefully that gives you guys at least some reasons why you want to look at owning Johnson & Johnson this month. I'd love to hear from you guys some of the securities that you've picked up on. And of course, please don't forget to hit that like and subscribe button, as it really does help the algorithm pick up creators like me. And until next time, take care, guys. Bye for now.